Peter Lampert, welcome back to the podcast.
Thanks for having me back.
Well, I'm always glad when you come back, Peter. It's wonderful speaking with you. And it's been a wonderful year for just international equities or non-North American equities in general. What's going so well? I mean, it's been a period of 10, 15 plus years in which, holding just U.S. equities would have done you pretty well for your portfolio. So what's happened this year that we've seen that reversal?
Yeah, I think there's been lots of opportunities in international markets, and investors are looking around now after the strong performance that they've had in the U.S. stocks for many years. More investors are looking around and looking at those opportunities. And I'm sure we'll talk about many of them today, but whether in Europe or Asia, there's a lot of great opportunities around the world that have been somewhat overlooked and overshadowed with the enthusiasm for U.S. stocks and the success of the Mag 7.
Okay, great. Well, I did want to walk through certain aspects of the portfolio with you today. And I assume that, part of the reason that international stocks in this portfolio have done so well over the past year or so has really been in the AI and the technology space. Can you talk through just, stepping back as a portfolio manager, how do you think about your AI exposure in the portfolio and how do you break it down?
Yeah, again, coming back to the US and the rest of the world, there's a lot of focus on NVIDIA and how they're driving the AI boom, and the Mag 7, the hyperscalers, companies like Microsoft, Google, Amazon, that are all employing AI and providing AI. But what we see in the rest of the world is a lot of the AI enablers throughout, especially in Europe, in places like Taiwan and Korea, where the semiconductor supply chain is centered. And we see a lot of opportunities there. So we've gone through the supply chain and looked at where are the best opportunities. And one thing that we find is this is a real benefit of being a bottom-up investor when we have such a thematic shift. Many can see the long-term outlook and the strong AI CapEx spending, and many stocks get lumped together, and we see a rising tide lifts all boats. But if we look through that, there are probably some companies that are having a short-term bump, and then that will revert. As soon as the supply-demand mismatch reverses, the extra profits that they have now should come away. But there are other companies, the ones where we're focused, and what we're looking for is companies where their competitive position and their outlook has actually improved. They've gone from being a position of strength pre-AI to even stronger in an AI world. And that's what we're looking for. And then we're looking to diversify that exposure across the portfolio. So right now, about 20% of the portfolio, I would say, is kind of tied to these AI beneficiaries. Still, lots of other great opportunities in the portfolio. It's not all AI. But within that AI bucket, we want to manage the risks and find the companies that best meet our criteria of being great long-term wealth-creating companies.
Well, can we dig a little bit deeper into some of that and just sort of, we spent a lot of time on TSMC on this podcast over the last couple of years. I know it remains one of the higher conviction holdings within this portfolio. But you mentioned the ecosystem or the value chain, the supply chain that is built largely in Asia, Taiwan, South Korea around TSMC. Can you just bring to life some of what we're finding within that bucket of, hey, companies with magnificent competitive advantages there?
Yes, like you said, TSMC is our largest holding and certainly a big beneficiary and enabler of the AI revolution that we're seeing. But there's many strong companies. So, for example, in a company in Taiwan that makes power supply units. So every server in the data center needs a power supply, and the leader went from having the leading market share of about 30% to now in traditional servers to now about 70% market share in AI servers at higher prices, higher ASPs, higher volumes, and higher market share. And we think that's sustainable because this company has always been the market leader with the best products, the highest quality, and the highest reliability. It's just that for traditional servers, the differentiation didn't matter as much. Whereas in AI servers, where they're so expensive, the downtime is so important, so expensive if your server goes down. Having that reliable power supply, the electricity costs are so high, having that power efficiency that the leader can provide is a huge advantage. And for that reason, we're seeing them strengthen their competitive position and customers willing to pay for that. We see the same thing with the leading supplier of rail kits. In a data center, every server is on a compute tray that needs to be able to slide out for access and maintenance. And again, the market leader there went from about 30% market share in traditional servers to now 90 or even perhaps 100% market share in AI servers, because this is a small cost, but high cost of failure. If the server rack breaks, if it drops, and the network, if the server goes down, it's costly to replace, and the downtime itself is costly. So again, just this company has always been the leader. It's just that value to the customer is that much more important. And we see these as sustainable long-term beneficiaries, not just benefiting from a short-term supply-demand mismatch, because of the decades of leadership strength that they have in their R&D, in their product know-how, and being able to keep up with NVIDIA and the product roadmaps of the leading customers.
Yeah, your description of the rail kit. If I open my cutlery drawer and it drops to the ground, so what? But I can imagine with like millions of dollars of AI servers on the line that you want to be associated with the best in that regard. Can we shift to another area that I noticed in the portfolio is just a bit more focus in terms of what's come in on the memory side?
Yeah, certainly. You know, as we look through this, the AI supply chain, what we've seen, a lot of the beneficiaries have been on the logic side. That's NVIDIA, as an example, designing GPUs, which are logic chips made by TSMC. But there's a whole other half of the semiconductor supply chain, largely the leaders are based in Korea. So the leading manufacturers there and their suppliers. And that's become an increasingly important bottleneck or choke point in the advancement of AI. NVIDIA and its competitors are designing chips that rely more on high bandwidth memory, and it's a stronger outlook for the companies that can supply that. They're very supply constrained right now, and to the extent that they need to raise prices, they will bring on more supply, but it will take time. And in the meantime, they will earn, supernormal profits. And what we're seeing is that cascade. So the leading makers of this HBM memory are also the leaders of DRAM and NAND memory, the other more commoditized types of memory. And as all of the investments and capacity is going toward HBM, we're seeing shortages in the others memory types as well. So we're seeing the memory companies benefit kind of across the board, and a much stronger outlook. And although that is a cyclical industry where there have historically been booms and busts, we think now the technology capabilities are higher, barriers to entry are higher, and the supply constraints are longer. So any cycles should last longer, and we're potentially entering a period of prolonged high profitability for the main memory manufacturers and their supply chain.
We started the podcast just comparing the international space to the US space. I mean, one of the differences has been just valuation starting points as potentially a contributor for why international equities have done really well this year by comparison. Does that apply to this space too? Meaning AI exposure seems optically pretty expensive in the US market. Is it considerably less expensive in terms of the companies that we've been talking about?
Yes, definitely, especially if you factor in the growth outlook. Some of these companies, that's another thing we're looking for, not only where the companies, their competitive positions have improved, but companies in niches that are outgrowing the entire AI investment. So while the entire AI CapEx investment is growing and bringing along kind of everybody involved in the supply chain, the niches that we focused on are growing even faster. The power supply need, the need for rail kits, the need for memory are outgrowing even faster than the overall growth in AI CapEx. So when you factor in both the increased growth outlook, the even stronger sustainable competitive advantages, as well as the valuations. We think there are many very attractive opportunities. And just, to give you a sample, the HBM memory that we talked about, there are only 3 players globally that make this. The 2 leaders in Korea, and then a third player in the US. And the Korean players, even though they're maybe the technology leaders, trade at much lower multiples just on a simple price to earnings multiple. And when we translate that to our DCF models, we see much more upside there.
Okay. I want to ask you one last question in the topic of AI enablers, but just can you play the other side for us? Or put differently, how do you get comfortable with the aggregate weight within the portfolio to these types of businesses?
Like I said, there's a lot of businesses that are benefiting, and we think there's a strong long-term outlook, a good case for continued investment in AI. But it's still early. The use cases haven't fully come through. The adoption needs to come through from end customers and corporates and consumers to justify continued spending in AI. And if the consumer adoption is slower, the pace of investment could be slower, and there could be some disappointment. So we need to manage that risk. Again, I mentioned about 20% of the portfolio kind of exposed to this AI investment theme. And that's within that, well diversified, I think. We talked a lot about companies selling directly into the semiconductor or data center supply chain, but that also includes companies further down, in supplying electric grid equipment that are kind of adjacent to but also important enablers of the AI spending. So within that, we think it's well differentiated or well diversified, and we're managing the weight at the portfolio level. And then there's lots of other companies in the portfolio that have their own drivers and can benefit from other growth opportunities.
Well, can we shift to some of those? One heuristic or shortcut might be, okay, you got 20% of the portfolio that's really enabling AI. Does that mean that the other 80% is at risk because of AI? I know we've seen some companies in the portfolio really kind of go back and forth sentiment-wise as to whether they're an AI winner or AI loser bucket. Can you speak to just some of those companies, what we're grappling with, what the nature of the debate is, and ultimately where we get comfortable with some of these businesses?
When there's a change like this, investors are trying to make sense of it, trying to gauge the odds of success and failure. And for the existing incumbent software companies, it's a puzzle for investors. Are they well positioned to add AI functionality to improve their offering and to actually grow their revenues and profits from enhancing with their products with AI functionalities, or are they at risk from AI native new entrants coming into the market? And we have a number of those in our portfolio. Companies like Wolters Kluwer and Relics, they're industry leaders in their niches. They provide software along with all of the data needed to support their customers, which are largely doctors, lawyers, and accountants that rely on them for the essential reference information that they need in their day-to-day workflows. These companies are augmenting their products with AI functionality. You could think of a lawyer drafting contracts, but instead of using something like ChatGPT, using something from Relics, a provider that they've worked with for decades, where they trust the company, where all of the data going in there is vetted by thousands of experts, and they have a higher degree of confidence that the AI is giving them reliable output. So that's the advantage they have. But at the same time, they have to maintain that trust. So they have to move a little bit more slowly. They can't just come out as soon as there's a new product or functionality. They can't just throw it out there and see what happens. And if it starts hallucinating and giving misleading information, they have to make sure that the products are ready for prime time before they roll them out. Whereas that's the advantage that AI startups have. They don't have thousands of in-house experts vetting all the data, vetting all the information. They don't have decades of a trusted brand to protect. So they can take those risks on new products. And we've seen some traction there. We've seen in the legal space, in the medical space, where there are very well-funded companies. VCs are pouring hundreds of millions of dollars into companies before they even have revenue, and they're able to gain some traction, to gain some customers. So open evidence is one credible threat in the medical space, challenging Wolters Kluwer. Harvey is a threat on the legal space, challenging both Wolters Kluwer and Relics. And, for us, it's really case by case, trying to determine if the incumbents are well positioned to navigate this, navigate these challenges, if they have a management teams that are investing and forward looking, thinking about how to adapt to this environment, or if they're complacent management teams, more at risk of disruption. And so we think these companies are well positioned. But like you said, the market has gone back and forth. At one time, these were priced quite robustly, thinking about the AI upside, and now the market's become more pessimistic on them, looking at the AI downside and the disruption risk. So for us, we're taking a long-term view. These remain core holdings for us in the portfolio, and they add to that diversification. If the AI adoption is a little bit slower, investor enthusiasm for these stocks probably returns, whereas for some of our other AI beneficiaries, it may diminish. So having that portfolio approach, having different diversified approach in the portfolio, with each individual company being great on its own, but in a combination of portfolio, having that diversification provides more resilience.
I want to ask about Japan. We had one of your colleagues, Ian Turnbull, on the podcast not too long ago, who had returned from a trip there. And I've noticed in the international portfolio that we have added a number of Japanese companies. And this would be, over the course of the summer, but even going back a year or two, you've seen that weight come up. How much of this, Peter, is related to, what you read in the news with respect to, we're seeing all these corporate governance improvements in Japan, versus is there any other theme that connects why we just happen to have found some great Japanese ideas?
Yeah, there have been a few different insights that have led us to increase our weight in Japanese holdings, and really on a bottom-up basis, finding great companies. So yeah, you mentioned one theme that the market's been focused on is this push in Japan for improved corporate governance. For decades, Japan's been a laggard in terms of adhering to global standards and norms, of creating value for shareholders and the mindset of earning a good return on invested capital. But that's been slowly changing in some cases. I wouldn't say it's a paint with a broad brush that corporate Japan culture has changed across the board. But we have found examples like Hitachi in the portfolio where it is a fantastic world-class management team. And one way they accelerated that shift from kind of the old corporate Japan mindset to a world-class modern global company is through acquisitions. And when they've made overseas acquisitions, they've retained that talent, brought over some of the overseas people into the top executive level of the company, and really brought in the global best practices and global thinking, which is quite rare in Japan to see a globally diverse leadership team. And so that's benefited them. They have that's informed their strategy to focus on areas where they can earn a high return on invested capital and build sustainable, strong, long-term competitive advantages, and slim down from this very diversified conglomerate to a much more focused business on key business segments where they have leadership opportunities to generate high returns. One example of that is in the transformers, being the leader, supplying transformers for the electric grid, which is important for this AI build-out that we talked about. But then as well, there's lots of other reasons that have led us to opportunities in Japan. Hitachi, that's sort of on the large cap side. In the overlooked kind of smaller cap end of the spectrum, we've found just really good entrepreneurial management teams that have found unique market opportunities and are taking advantage of that. And so they're nimble, they're profit-oriented, and in many cases, they're competing against more traditional corporate Japanese companies that are much slower to react, much more bureaucratic, and as a result, they can just be more efficient, more customer-focused, more competitive on price, provide better service, and they're winning that way. And a lot of these happen to be in the tech industries, providing software or IT consulting, because that's an area we've noticed Japan, again, has been a laggard in terms of corporates adopting modern software and IT. Typically in Japan, companies have used in-house IT, developing their own custom software, and that relies on a large workforce of external IT consultants to maintain all of that legacy software. That's becoming more and more challenging for them to do, given the declining population and shrinking labor force in Japan. There are just fewer IT professionals to provide that service. So the companies that can provide that service, or an alternative like off-the-shelf software, which is common in the rest of the world and doesn't require as much labor, is a much more attractive option. So we have a number of these companies run by entrepreneurial founders, identifying this need in Japan and providing, software for expense management, invoicing, travel management, all the things in the Western world, we might take for granted these would typically be done with off-the-shelf software, but in Japan, that typically hasn't been the case traditionally. So lots of reasons why we found these various opportunities, but generally, yes, there are pockets of improved governance. There are pockets where entrepreneur-run businesses are just out-competing their more traditional, slower competitors, and opportunities, especially in the IT demand.
Peter, bigger picture. And by the way, that discussion we just had in Japan might be part of the answer. It might not. But as you look forward to next year, but dare I say the next 5 or 10 years, what are the key places where you're just really optimistic? So either opportunities or trends that you expect to be really in focus. And then I do want to keep you balanced. What are you most worried about too over that time horizon?
Like we've talked about, there's a lot of opportunities in AI. We talked so far about the companies enabling the CapEx build out, but then once we see more use cases of the AI tools, we'll see tons of opportunities, whether that's a company like a Wolters Kluwer or Relics that can benefit from that. Tencent is another clear example where they are already benefiting today from higher ad monetization through having better AI targeting in their ad algorithms, and being the internet leader in China. They're in social media, e-commerce, payments. They have plenty of opportunities to monetize AI throughout their offering. So once we see more and more use cases and consumers and enterprises willing to adopt those, I think we'll see much more upside from AI. Another big area of spending and opportunity is in European defense. We've talked about this on previous podcasts, but we are going through a generational shift where Europe as a whole has underspent on defense, and they need to catch up, spend more on defense. And there are many great defense companies that can supply that and meet that need and benefit from that theme. Japan, the underinvestment in IT that has gone on for decades. They now have an urgent need to close that with the labor shortage. Again, there are opportunities there. So, and then there are, plenty of opportunities that don't fit into any of these themes, just in idiosyncratic opportunities. A company like Wise in the portfolio, many of our listeners probably use them. I use them for my cross-border FX payments. And it's been a great business. They've come up with, they've disrupted the traditional legacy banks with cheaper, better payments, cross-border payments, FX offering. And now they're expanding from just providing that service to individuals and businesses, but really providing that on a white label offering to banks themselves, the very banks that they've disrupted, because they have lower costs, better offering, faster service times. So that's an example, not really tied to any of those themes, but just a great execution by a great management team targeting a large opportunity. And then on the flip side, there's always risks. There's always risks that we have to manage. So everything we talked about, we look to manage those risks in the portfolio, whether it's thinking about the aggregate exposure to this AI CapEx build out or to the Japan IT industry, or the European defense industry, and just managing those risks, making sure the portfolio is well diversified, because you never know what's going to happen. And for us, we're not trying to be the smartest guys in the room and predict the future, but just build a resilient portfolio. If we have in an environment of heightened geopolitics, heightened trade wars, also heightened hot wars, these are all important risks that can derail an investment case. And we need to navigate that, maintain a well-diversified portfolio, and focus on the long term.
Great. Well, Peter, appreciate your time today. That sounds like a pretty good place to end, and certainly appreciate your stewardship of our clients' assets for many years at this point.
Thanks, Rob.